Uber Technologies filed its IPO registration statement with the SEC on Thursday, with the IPO date set in around 1 month's time, giving investors time to read their prospectus, which is a good thing as it's long, around 468 pages. To give some perspective, that's twice as long as the average novel. It's also quite revealing. The company registered $50 billion worth of gross booking sales in 2018, up 45% from 2017. Of the $50 billion, $39 billion of that went to the drivers. Uber estimates that their meal delivery addressable market is in the region of $800 billion. Uber freight sales were $125 million in the fourth quarter of 2018, a figure significantly higher than many analysts had been expecting. This diversification into food delivery and freight, away from operating solely a ride-hailing business, will of course be to Uber's advantage. It is also one of the factors that sets it apart from its rival Lyft, whose IPO has not gone quite as well as might have been expected. Of course, Uber is also significantly larger than Lyft, with a much wider global presence, operating in 6 continents, whilst Lyft operates almost exclusively in the US. Some readers may have been interested to learn from the prospectus that Saudi Arabia's public investment fund owns 5% of Uber. This public investment fund is also an investor in SoftBank's Vision Fund, which owns 16% of the company. Uber's IPO is expected to be one of the biggest tech debuts of 2019, with its $100 billion valuation making the company, founded in 2009, worth almost as much as the US's 3 major automakers combined, with General Motors holding a current valuation of $45.3 billion, Ford $35.1 billion, and Fiat Chrysler $31.8 billion. However, after looking at the financials, some analysts may have been left thinking that the $100 billion market valuation could prove a stretch. It showed core revenue flattening in the past few quarters, suggesting that the global ride-hailing opportunity may not be as large as either Uber or Lyft enthusiasts had believed. Uber's core revenue totaled $2.54 billion in the fourth quarter of 2018, almost the same as it was in the second quarter, amid continued operating losses that totaled $3 billion last year, compared with losses of $4.1 billion in 2017. The prospectus states, "We anticipate that we will continue to incur losses in the near term as a result of expected substantial increases in our operating expenses. We may not succeed in increasing our revenue sufficiently to offset these expenses. We expect our operating expenses to increase significantly in the foreseeable future, and we may not achieve profitability." Clearly though, it's a growth business, and whilst the losses are indeed significant, with advances in autonomous technology, the company will most likely be able to find ways to cut costs and keep more of its revenue from bookings, with less or possibly no drivers to pay. This would also be a way out of the potential legal issues that they are facing, determining whether their drivers can be classed as self-employed, or if they are in fact employees. The prospectus acknowledges this, noting, "If, as a result of legislation or judicial decisions, we are required to classify drivers as employees, we would incur significant additional expenses. Any such reclassification would require us to fundamentally change our business model."